Hello, everyone, and welcome to JFLA's Financial Literacy Series. My name is Linda Feinholz, and I'm a proud past president of the Jewish Free Loan Association and past member of the board of directors. Today, I'll be introducing our speaker, Richard Roche, who is here to present on the topic of debt management. So, just some housekeeping first. In order to have the best experience today, be sure to click in the upper right-hand corner of the window where it gives you options for how to view and select speaker view. That's going to give you the best presentation. During the presentation, please put your questions as they occur to you in that Q&A box. And if we need further clarification, we'll let you know. When it's time for our Q&A session, I'll read out your questions so that Richard can answer them. And as we go into Q&A, we're going to post responses as well as talk through your questions. So as many of you know, Jewish Free Loan offers zero interest, zero fee loans to anyone facing a financial challenge. We are not a bank, and we work with our clients to make sure their payments are manageable. If you're interested in learning more about our loans, whether for student loans, emergencies, small business, or another reason, please visit jfla.org to see the full range of loans we offer. They're all zero interest with no fees at any time. Today, I'm really pleased to welcome Richard Roche. Richard is a mathematician who worked as a life insurance actuary and as a structured finance analyst during his 30-year corporate career. After leaving the corporate world, he taught high school mathematics at Birmingham High School and the Los Angeles Center for Enriched Studies for 7 years. After retiring from LAUSD in 2012, he became involved in math education research, working as a visiting research scholar at the USC Rossier School of Education, as well as serving on the school's board of counselors. He's also taught as an adjunct instructor at LA City College and Santa Monica College. Richard, welcome. The floor is yours.
Thank you, Linda. And I'm going to share my screen with everybody. Hopefully this will work properly. And we're going to go into slideshow mode.
Perfect.
Okay. So, good evening, everybody. My name is Linda said is Richard Roche, and I'm really honored to be speaking with you today. This presentation is hosted by the Jewish Free Loan Association, which has been serving our community since 1904. And it's an incredible resource that more people should know about. So tell your friends. Tonight's session is called Smart Money Moves, and I've designed it to be a practical guide for anyone who wants to take more control over their finances. Whether you're struggling with debt, trying to create some breathing room in your budget, or thinking ahead to long term goals like saving for retirement or starting a business. We'll talk a little bit about how to understand and manage debt, use credit wisely, build a cash reserve, and make smart budgeting decisions. I'll also touch on when it makes sense to invest and how to avoid common financial traps. My goal is not to overwhelm you, but to empower you with tools and strategies you can start using immediately. And remember, there's no judgment here, just support, ideas, and encouragement. So let's get started. Why is financial literacy so important? Managing your money isn't just about having a high income or owning a lot of assets. It's about how you handle the resources you do have. And for many people, especially those living on modest incomes or running small businesses, even small changes can make a big difference. When you don't have a plan for your debt, your savings, or your spending, things can spiral out of control quickly. You might find yourself behind on bills, taking on more expensive debt just to stay afloat, or unable to cover an emergency like a car repair or a medical bill. The stress from that can affect every part of your life, your health, your relationships, even your ability to work effectively. But here's the good news. You don't have to be a financial expert to make smart decisions. Once you start looking at how your debt, your savings, and your expenses interact, you can begin to take steps, small ones at first, that give you more breathing room and peace of mind. This isn't about perfection, it's about progress. And that starts by understanding the landscape. So, one of the first questions to talk about is knowing how much debt you can actually afford. There's a rule of thumb that basically says to keep your total debt payments from all sources of debt under 36% of your monthly income. Some people might say it's a little bit lower than that, 33% or even 30%, but 36% is a probably a reasonable number in the current economy. And what that means essentially is that if you were earning $2,500 a month, your maximum monthly debt load should be about $900. And if it was 5,000 a month, it should be about at most $1,800. But that includes everything. It includes your car loan, your credit cards, any student loans you might still have outstanding, and any other debt payments that may be recurring. And why does this percentage matter, this total? Why do we care about maintaining a debt load below a certain point? It's because if it takes up too much of your income, you have less room to save, less flexibility when emergencies come up, and more stress in your day-to-day life. Even if lenders are willing to give you more credit, it doesn't mean it's a good idea to use it. I'm sure we're all familiar with the endless parade of credit card applications that come flooding into our mailboxes every other week that that try to lure us in with a great deal at the beginning, and before you know it, you've got four more credit cards that you're paying making debt payments on. So knowing what your personal limit is a powerful step in protecting your financial future and your peace of mind. Now, let's take a look at what the difference is between good debt and bad debt. Just because debt is something that you owe to other people, it doesn't mean that all debt is bad. For example, student loans are an example of good debt because essentially that's an investment that you've made in your future. Mortgages on a home are examples of good debt because you're building equity in real estate property. Business loans can be good debt because they allow you to purchase more inventory or deal with whatever the needs of your business happen to be. Bad debt, on the other hand, is payday loans, um, high interest rate credit cards, and rent to own. Okay, so bear that distinction in mind. So, some signs of being at a dangerous level of debt would be if you have taken on the habit of only making the minimum payment on all your credit cards or any place where you have an option as to how much to pay. Obviously, for mortgages and for car loans, the amount that you're supposed to pay each month is fixed, but on a lot of other types of debt, how much you pay is up to you. And we'll come back to this point in a moment. If you're borrowing to pay off other debt, that's usually a bad sign. The one exception I would say is if you can find a good deal on debt consolidation types of loans where a single debt payment at an interest rate like say 12% may help immediately get rid of all the debt that you have at 15, 18, 20, 25, or even 30%. And a really obvious sign that you're in danger is if collectors start calling. Now, one can be smart about credit cards and one can make bad decisions about credit cards. So, in general, you should always pay in full whenever possible, but that's not always going to be the case. It's always very important to know what your interest rate actually is. The limit in California is somewhere in the vicinity of 30% or even a little bit higher. And even if your current interest rate were say 16%, if you were to miss a payment, they can change the rate that they're going to charge you for the following month up to 28 or 30%. Don't ignore fees that might be associated with the credit card. Try to avoid having too many cards. Two other smart moves might be to set auto pay for statement balance, if at all possible, or set it up for auto pay the minimum plus some fixed amount and have it auto paid out of your checking account. You also might want to turn on due date and utilization alerts in whatever banking apps you have on your phone. So it might be useful to have those reminders that pop up 3 or 4 days before the due date on a payment if you have not set up auto pay. If you had $1,000 in credit card debt and your APR on the credit card was 18% and you only paid the minimum, it could take years and ultimately cost double what you pay. And some more practical examples using this $1,000 at 18%. If the minimum is $25, it will take you approximately 5 years to pay off the loan, and you will have accrued $500 in interest rate charges. If you were to pay $50 a month, which is only twice as much as that minimum, you'll be paid off in 2 years and pay only $200 in interest. And if you could manage $75 a month, you'd be paid off in 15 months and only pay about $120 in interest. So you can see how very small changes in addition to the minimum on your credit card debt can really save money in the long run. Let me take a pause at this point just in case any questions have come up.
Richard, there have been a couple of questions with regards to that 30 to 36%. One of the questions is that calculated before or after income taxes? And is that including house payments? So if you've got a mortgage, if you've got, I'll say rent, even though there are different kinds of debt.
I believe the 36% is after tax because you can't pay with the money that's been already given away, given to the federal government. That money isn't available to you to spend. So I think in the example that I gave where your monthly income is $2,500, that was after tax.
And then when we're talking about debt, is that 36% inclusive of housing costs?
It's debt from all sources,
Okay,
right?
thank you.
I believe if I'm not mistaken, it's been so long since I've talked to a bank about a mortgage, but I do seem to recall that the when a bank decides whether or not to give you a mortgage, I think they want the the loan payment plus insurance to be no more than about 28%
Okay.
of your after-tax income,
Okay.
something like that. So,
That,
but yes, it's all debt from all sources.
that's very helpful to understand. That's it for the questions on the material so far.
Okay, great, thank you. So, different people will have different approaches as to how they deal with debt. And it doesn't really matter what your approach is as long as you pick one and are consistent with it. So, the avalanche approach is the one in which whatever loan that you have that is at the highest interest rate, try to pay that off first. Okay. And the snowball is pay off the loan that has the smallest balance first. And you could see pluses and minuses to either one. They all for example, on the in the for the avalanche form, getting rid of the highest interest first reduces disproportionately how much interest is being paid in total because the biggest contributor to that is now gone. On the other hand, the snowball might be very good for motivating because, oh, that's one that wasn't that hard to get out of the way. Now let's go to the next smallest balance. But the important thing, and there are probably other approaches, it's easy enough to look up, but just pick what keeps you motivated. Now, in sort of an ideal world, uh, when we're talking about a budget in general, we have various needs. We have housing, we have food, we have in some cases we have daycare. We have various needs that are sort of non-negotiables, and we have wants and we have debt. Now, you're clearly not going to be able to have 30% of your income going to discretionary spending on anything you want unless your total debt is at 20% or less. If you need 50% for, say, housing and food and other sorts of things. But it's when we talk about what is it that we want, particularly in the context of needing to be particularly mindful about what our spending is, sort of trying to stay on top of our debt and things like that. That $5 latte that we've gotten into the habit of having every day just because it's a convenient place to get our coffee jolt and maybe say hello to a friend as we go into the coffee shop to on our way to work. That's really a want and not a need. And $5 a day is $150. And if you think back to that $75 a month instead of the $25 minimum, just cutting back half on your Starbucks would probably save you 3 years of interest payments on that credit card. Okay. So this is just a helpful starting point for budgeting. And also, we probably also need to recognize that living in Los Angeles or California in general, we live in a very high cost environment for housing. So 50% for your needs may not even actually be enough. It may be closer to 60%. But whatever it is, you're going to have your needs. The debt is usually a non-negotiable sort of thing. And so your wants, think of your wants as the balancing item, not the debt. So you're going to want to build a simple budget. You're going to want to track your income, keep track of your expenses, make sure you know which expenses are fixed expenses, which expenses are variable. So groceries are variable, gas is variable, electricity is variable. Uh, you're obviously going to be spending something on groceries, but anybody who's bought meat in the last year or two knows that steak is now about twice as expensive as it was 2 years ago, and even ground beef is getting really expensive. So it may be time when looking at what your food budget is to make some adjustments to give yourself a little bit more breathing room in other components of the budget. Tools you can use to keep track of things. There's apps like Mint or Every Dollar. Some people are comfortable using spreadsheets. Some people are comfortable with something as old-fashioned as what's referred to as the envelope method, where there was an envelope for the rent, and there was an envelope for groceries, and there's an envelope for going out to the movies, and then there's an envelope for saving for your credit card bills. But whatever works for you. And it's always really important to have some kind of an emergency fund. And where you would like this emergency fund to end up at as a minimum would be you want to have 3 months, possibly even more, of essential expenses that you can easily get your hands on if there is an emergency. So you and the emphasis on an easy access account. So don't think that, because a bank may be offering you, say, 3% on an 18-month CD, and they're only offering you 1% on their savings account, but you can get at the money anytime you want. Put the money in the 1% account. Don't get a CD, because there obviously the risk is some emergency is going to come up before the 18 months are over, and the penalty for breaking into a CD is probably going to be, you may be lucky to get all of your money back. You'll probably get all of your money back, but you'll be getting less than the interest that you would have been earning in the 1% savings account with daily access. And you don't have to feel like you have to have 3 months already on hand before you sort of set up the account. If you've got $100 spare that you don't need that month, put that, open a savings account with $100, and then build up to 1 month's worth of essential expenses, and then build up to 3 months. But get started. So as I said, there's online savings accounts, there's credit unions, money market accounts work well. And all of these, this is relatively easy to research online. And also an organization like JFLA would probably be able to point you in the right direction of where to look to get a good rate where you will be able to access your money and your money will be safe. And if they don't have the information immediately at hand, they can point you in the right direction. So let's pause here and see if there are any new questions that have come up, or if any.
All of the questions have been answered so far.
Oh, okay. Um, All right, so let's move on to a topic of investing versus paying debt. Um, I would say that, you know, uh, you probably should not give serious attention to investing until you have your emergency fund set up, because that first $100 probably should go into the emergency fund as opposed to the next Nvidia or the next hot AI stock or something like that. Um, but the question of when should you invest versus paying off debt? Should you not invest until your debt is completely paid off? Well, that's probably not a great idea, because a lot of people who are still paying mortgages on their home also have investment portfolios. So they're not waiting to pay off their mortgage before they start investing. And one of the reasons for that is, in general, the interest rate on your mortgage, and also in a lot of cases, the interest rate on your student loan, that is low interest debt. And um, so you probably should not be investing a lot of spare money if you still have lots of high interest rate debt. You should probably focus on paying down that debt before you start investing, because ultimately the goal is to make more on an after tax basis by investing, to more than compensate for whatever you're paying on your debt, and to basically grow your portfolio. Now, for the people who have some interest in uh, business, if they have businesses, I'm sure that some of what I'm going to say you have heard before, but it probably bears repeating. And hopefully, there might be one or two things that you'll be able to still take away from this. So, there are a couple of special things to keep in mind when it comes to managing your money if you are running a business. One would be that you should keep your personal and your business finances separate. So you really shouldn't be paying for your business expenses, inventory, supplies, business meals, whatever. Do not pay for that with a personal credit card. Try to get a business credit card that the only you and your authorized users, if there are any, whatever gets charged to that card is related to the business, because this is ultimately going to be really important for the accounting aspects and the financial aspects of the business and tax filing and all that sort of stuff, and being able to show that this expense is for business, as opposed to submitting to the um, IRS as documentation for paper supplies that you bought at Staples, something that shows up on your personal credit card as a charge to Staples, and you've got no way of proving that, well, that was for the printer in the office and not for the printer that's in your house. Um, you want to monitor your personal and business credit. So make sure you set your auto pay and due date alerts on. For business credit, you want to get yourself a DUNS number. Use some net 30 vendors and pay on time. That'll help build up your credit. Check your personal and business credit reports twice a year and fix errors quickly, Strong credit is oxygen, easy to ignore until you need it. And borrow carefully with a repayment story. So you have to match the loan term to the purpose. So if you have short term cash gaps, go for a short term payment. If it's equipment, it's longer term. You want to calculate the total cost of capital. So it's not just the interest rate that's on the loan itself, but it's going to be your fees. You're going to have to factor in compounding. You're going to have to factor in your payment frequency, daily debits or a warning sign. So use two guardrails, use a rolling 13-week cash flow, and also your debt service cover ratio of at least 1.2. 1.1 is a little bit too tight. 1.5 is really good. Um, but you definitely want to be at 1.2 or higher. And there are also, no matter what kind of problem comes up, no matter no matter what your sort of educational or strategic needs are, bear in mind that there are organizations such as SCORE, which is an organization of retired executives who have enormous expertise. They can do free confidential help. They can you can have a free consulting call, free mentoring. They can come in at very modest hourly rates if you need a lot of hands-on consulting help, but they also have a lot of free or very low cost webinars and classes. So that's another great resource for small business owners. Now,
Richard, but
yes,
before we move on to the debt traps, I've got three different questions that came up.
sure.
Um, could you explain what a Duns number is?
That is Dun& Bradstreet, I believe. It's a number that is used to essentially as it's part of a registry of all kinds of businesses, so that you can be. And I'm not really an expert on Duns because I've never actually run a business. Um, but I think it's something where um, potential lenders would be able to look you up and get some easily accessible, very basic financial information about you, what your business credit rating might be, what percentage, you know, uh, whether you have, say, late payments to your net 30 lenders or net 30 vendors and so on.
Okay. And then can you explain the 13-week cash flow cycle concept?
Well, um, not every business has completely predictable day in and day out cash flow. There are going to be days when it's the time of the month where you purchase whatever supplies you're going to need for the next, office supplies for the next month, or where there's you have a loan that has been structured with some sort of a balloon, and the balloon might be coming due. Um, or um, and so you you really need to, over time, develop a sort of a good feel for the ebbs and flows of your cash flow, so that and 13 weeks is approximately, well, it is 1/4 of a year, and a quarter is a typical reporting cycle. And so you probably want to get some sense of when, the amount that you have available in cash or other forms of ready assets falls below some level where you're going to, in 1 week you're going to need it for that, or in 2 weeks you're going to need it for that, or in 3 weeks you're going to need it for that. If you don't have the cash on hand, then you better get busy um, how you're going to meet that potential gap. At the same time, um, business may be good, and your cash flow may be averaging sort of like well above some upper bar where you'd want to be to safely be uh, on a day-to-day basis. Well, that might be your opportunity to start putting some aside for, well, I know that I need to replace this piece of capital equipment within the next 3 years. So I'm going to take some of this excess cash flow and put it in sort of in the investment fund for that new machine.
Great. Thanks.
Is that it?
Yep. Thanks.
Okay. So we're getting towards the end. So a couple of final things to keep in mind. Um, so we want to avoid some of the common debt traps. I mentioned payday lenders before. Um, it sounds like a great deal because for one reason or another, you might not want to wait until Friday to cash your paycheck. You've got something that you really want to do today or tomorrow, and you're willing to go to a payday lender to get the money today and give them your check on Friday. The problem is that they often charge annual interest rates that are 300% or more. So in other words, if you were to, if you, um, if your paycheck was say $300 and they gave you $200 up front, and say, okay, you don't have to pay this back until 2 weeks from now, you're not getting any money back. That $200 is all that you're going to have, because the difference between the $300 and the $200 is the interest that you would have paid. So they are, I would say, unless it's a life or death thing, they are the lender of last resort. Buy now and pay later. Um, it's not really gimmicky necessarily, but it is dangerous, and not everybody does it the same way. And there's also a psychological problem with buy now and pay later. I mean, in some sense, if we get something, we kind of need psychologically the pain of paying for it. If we are getting things without having to pay for them right away or relatively soon, are we just start almost naturally thinking that we have more that we can spend than we really do. And that's a dangerous trap to fall into. And also be on the lookout for hidden fees. So ultimately, you want to look at three basic questions. What is the real cost of this loan or this scheme? What are the penalties if I miss a payment? You don't want Guido and his buddies showing up to take care of late payments. And am I borrowing because I need this or because I want it right now? And it does take discipline and a certain amount of knowledge uh, to know the difference between needing it and wanting it right now. And I understand that in some cases It's going to be harder for some people than for others, particularly if you have, say, small children, and it's hard to explain to them why they might have to wait for that trip to Disneyland, because you just can't do it this month. But don't borrow just to go to Disneyland, even though the kids will love it, because they're not going to remember when you are getting up in the middle of the night worrying about how to pay for it. So if you get into any trouble, ask for help sooner rather than later. JFLA and its counselors can offer solutions. SCORE can offer solutions. There are lots and lots of organizations, 211.org, findhelp.org, Stay Housed LA, Magnolia Community Center. There are all kinds of local resources available, and I would urge you, whenever you feel overwhelmed by what you're dealing with, you're not alone. There are always going to be people and organizations around that are more than willing to help, and they do it because that's what they like to do. They like to help. So to recap the smartest money moves: understand how much debt you can afford, understanding the difference between good and bad debt, use your credit cards strategically and smartly, um, pick a pay down strategy if you've got a bunch of debt, and stick with it. Invest wisely, and we'll say more about that in just a second. Build up an emergency fund, and find a way to keep track of your budget. So at this point, I want to thank you. Thank you for giving me so much of your time. I hope that I haven't been overwhelming and giving you, it's a lot to take in, and I'm sure that JFLA is going to be around for any follow-up questions. You can always email them if they have trouble. I'm sure they won't have trouble answering any of the questions, but uh, uh, Linda and Mimi, you can feel free, and Jennifer, you can feel free to pass on any questions that you'd like some more detail on, or maybe we can have a follow-up at some point.
So, Richard, there's a question here that I've seen various versions of, and I don't know if it's a fit for this conversation, but the question posed was, if someone has a lawsuit court judgment, can a credit card company seize your Social Security retirement benefit income for unpaid credit card debt?
That is a legal question that I do not know the answer to.
Sort of a
And
tax lawyer who would need to
it's
answer.
well, yeah, not, and I think not only a tax lawyer, but a lawyer who also knows a lot about, debt.
Got it. Got it. Yeah, I know years ago I was told, the United States doesn't have debtor's prison. Like,
Right.
okay, I can put a check mark next to that. That's, helpful to know about our world nowadays. But I can understand uh the underlying question here is if there's a court judgment, is
Right. Well,
our company
I
allowed?
mean, I know that, I mean, just from sort of general background knowledge, I know that, for example, if there are tax liens, like say from the IRS or something like that, they can garnish wages, but I don't think they can go after Social Security. But again, I'm I'm not the right person to ask.
Got it.
Sorry.
And so folks are asking about the uh that list of resources. Folks, all of this has been recorded and we're going to be sending out a follow-up email. And this will be captured in the recording so that you can look at it slowly and take your time with that. So we additionally have a question of Do I need to make an appointment to come in and speak with someone at JFLA? And I will let Mimi and Jen hop on that. And thank you, Richard, so much for being here and what you shared. I know it, as you said, it's got enough moving parts and complexity. It's really important and useful to keep being able to revisit this issue of debt management. So, folks, we hope you will join us for our next financial literacy event, which is Thursday, October 23rd at 6 p.m. It's going to be focused on investing, and Richard's going to be joining us again to present on that topic. We're also sending out the recording so that you can revisit the material. And please feel free to forward it to anyone you know who might find it helpful. And now I'd like to turn this over to Jennifer Yom Tov, who's the Director of Advancement at Jewish Free Loan, to share some more information with you.
Thank you, Linda, and thank you, Richard, for such an insightful presentation. And thank you all for being here with us tonight.
My pleasure.
Many of you know Jewish Free Loan Association personally, whether you've received a loan, you've guaranteed one for a friend or a family member, or you've supported our mission through your generosity. We are proud to stand with our community in times of need, whether it's helping a family stay in their home, giving a student the chance to pursue college without the burden of high interest debt, or supporting an entrepreneur in starting a small business. We can only continue this work with the support of our community. So if you are in a position to give, I invite you to visit our website at www.jfla.org and click the donate button at the top of the page. Your gift of any size helps our small but mighty team be there for our clients whenever they need us. So thank you again for joining us. And Linda, I'll turn it back to you.
So that's it for me today. And Richard, I just want to share my appreciation again for your pulling this information together and making yourself available both for this and the upcoming investment seminar. So thank you so much. And thank you everyone for joining us for this and bringing your questions to the table so that the discussion can be enriched, and the recording will be including that discussion as well. So you'll be able to go back and listen to it again as well. So thank you all, and we look forward to seeing you in October.